Hello all, welcome to ETF Edge, your go-to program for all things ETFs. Our guest today, three of the best in the business all the time. Jan van Eck from Van Eck Vectors ETFs, Tim Seymour, founder and CIO of Seymour Asset Management, and Doug Jonas, head of ETFs for the New York Stock Exchange. Doug, I want to start with you and the big picture here. The rally is producing enormous inflows into ETFs. Just check some of the new numbers here. $400 billion in inflows so far this year. That's only the second time that's happened, that we passed $400 billion in a single year. And we just passed $5 trillion in assets under management for ETF. That's a real milestone. What are the major themes for 2021? And are we going to continue to see these kinds of big inflows? Or is this just due to the rally that we've been seeing in the last few weeks?
Yeah, Bob, I mean, you really talk about this record-breaking year ETFs have had. 2020 has been amazing. If we look at the lows from March to where we are today, about $2 billion per day is coming into net cash flow into U.S. ETFs. And so it's just been a tremendous year. And it's been a year of about opportunity. And also, you and I had discussed at the beginning of the year, would 2020 be the year for active management? And the answer is playing out in the form of yes. Active management this year, $45 billion in cash flow, almost double what we saw last year. But more importantly, it's been about growth. If you look at all the ETFs launched this year, half of those were actively managed ETFs. And so it's about active managers coming to the ETF marketplace and really showing their worth. And we're seeing it in both transparent ETFs, but also these new semi-transparent ETFs. ETFs where a manager doesn't have to show their holdings every day. We now have 15 of those that are in the market, 750 million in assets already. And so it's really been about the intersection of opportunity for growth, and then active management really coming and playing and showing their own in the ETF world.
Yeah, active management. We've been waiting for years for this to start moving a little bit. And it makes a lot of sense because right now the active management community is in trouble. They need to find a lower cost way to do business, and the ETF wrapper seems to be the right way to do that. I want to return to active management, but Jan, let me ask you, the inflows, it looks like in the last several weeks, they're all in equity ETFs. There seems to be big outflows from bonds and for gold. Is that going to continue into 2020? We've been talking about this, will we ever see outflows from bonds ever? It's been inflows for years. Do you think there's actually some legs to this story?
Yeah, I do, mainly because of the macro outlook and the fact that, the 10-year is so low. It's below 1%, right? A year ago, it was 1.8%. Now it's 8. What the phrase, I don't know how much you've been talking about this, but the phrase we've been talking about with clients is the 40% is broken, meaning the 40% of your portfolio that's supposed to be in bonds. And, institutional investors, advisors, individuals, no one wants to own a bond with that low an interest rate. So I think there will be that combined with our house view, which is that global growth is really underappreciated, meaning interest rates could go up, which would be bad for bond prices. So I think that, look, bonds are still, I think, $1 trillion in the ETF universe, so it's not zero, but I do think bonds face headwinds.
When you say it's broken, you mean that old 60-40 paradigm, which I never agreed with to begin with, doesn't make any sense anymore? Is that what you're trying to say? Is that what you mean when you say it's broken?
Yeah, that's exactly right. And, the great thing about treasuries, at least, is they provide a negative correlation to the rest of your portfolio. So bonds would typically rise like they did this spring, government bonds, when the rest of the world is having a tough time. But people are looking for alternatives to those diversifiers. They're looking at gold and other things. So, listen, some of the money movements with bond ETFs aren't bad. People are use ETFs for targeted exposure, and that's why you've seen some of the outflows. We have an ETF, a Fallen Angel ETF, which is a high yield ETF, and that's seen steady inflows pretty much all year long since March. So, different ETFs for different uses.
Yeah, I want to get back to the high yield in a minute because I know you've got some of those funds. But, Tim, let me turn to you. This value rally, this is like the oldest story in the book. We've seen fits and starts in value all throughout the year. Nothing has lasted at all. But I'm wondering if this one actually does have legs. All the value ETFs are up 15 to 20% this month. Doesn't matter whether you're talking about the S&P, the mid cap, the small cap. Even European value is up I think 17% on the month. that qualifies as like an eye-opener to me. I don't know, does it have real legs at this point, and why so, Tim?
Yeah, and you know, European value has almost been an oxymoron for the last decade, and that's part of where you're going with this. You know, if we think about what's been working, you know, and value is of course measured relative to itself. So there are sectors that are cyclical, but certainly, you know, are trading in value territory. And I think, yes, there's an argument in favor of industrials, transports, banks, even emerging markets, and some of this comes with you were just touching on the conversation with interest rates, and I just use the term normalized because I think we even get back to 140 to 160. 160 is really kind of where, if you look back, is where we started the year, and 140 as we really got into the teeth of COVID. I think you're going to continue to see that rotation, which would absolutely be benefiting banks, and banks on a relative basis are value territory. Some of the industrial names are benefiting not only from COVID trends, but also bottom-up fundamentals. I mean, look at the auto sector and look at some of those fundamentals and the fact that Ford and GM, as an example, are companies that have been value names for years. I mean, GM has been, you know, arguably a waste of an allocation for almost 5 years, and is now appearing like it's starting to move on company-specific fundamentals, but also this sense that you're, and Jan referred to this too, just that you're getting an industrialized response from the market, and you only need to begin to price in the beginning of a recovery to get this. I would just caution, though, we've seen this rotation multiple times in the last 6 months. And people were claiming growth was dead, triple Qs were dead in May into June.
Yeah. Jan, I'm wondering the broader question. We talk about value versus growth all the time as if it's a real asset class, and I've always had grave doubts about whether you can lump these companies together at all. I'm wondering if the whole value versus growth story is sort of irrelevant at this point. I mean, Tim mentioned banks and energy. See, this makes some sense to me. Banks are obviously rallying because yields are going up. Net interest income should be going up. That's a significant part of large banks' revenue base. So that makes sense to me. Energy stocks should be going up. The whole country, if you look at refiners, they're up 30% in the last few weeks. The whole country's acting like they're going to go on vacation in the first or second quarter of next year. Well, that makes some sense to me too. I don't know if value versus growth makes a lot of sense at this point. Should we just sort of drop that moniker?
I really agree with you, Bob. I do think that's an oversimplification, and really I think the whole industry has been moving away from value, even though it's a great simplifier. And I also like to look at on an industry basis. I think the bottom line is a company has to transform itself continuously to take advantage of technology trends, or there is no value at the end of the day. So Tim mentioned GM. That's a perfect example. Mary Barra there is trying to transform GM into a much more asset-light, technology-driven kind of company. And everyone needs to do that. Even asset managers need to do that. So I think financials and energy will get a reprieve. But if a big bank is not investing in technology, into the payments, the digital payments infrastructure and everything, they won't make it in the long term.
Yeah, I'm glad to hear you say that. I have been tired of the value versus growth story for a long time. I understand it's got a long history. I understand there's research going back to the 1930s about it, and I understand Graham and Dodd and all of that. But I don't quite understand why people think it's an amazing asset class. I prefer sectors that might be called value over that. That's enough for the editorial for the day. Doug, let me ask you, go back about the active management. How much more do you think this has to go? So we have $5 trillion in ETFs. I think that's a big milestone. We just hit that. But how much do we have in mutual funds? Still like 20 trillion, something like that, more than that? Do you see a significant move in 2021? I mean, is this the start of a big move from away from mutual funds into ETFs?
We think so. I mean, the opportunity set of ETFs has always been there. We understand their tradability, their lower cost infrastructure, the ability for an active manager to package their same alpha, but put it in a wrapper that's going to be much more tax efficient and have global distribution opportunities. So it really is a better mousetrap, if you will, for an active manager. And now they have a solution to be able to put into place where they can still do active stock picking. They can still manage their own money without investors seeing what they're doing every single day, with that veil of transparency, if you will. that ETFs typically provide. And so now it's an opportunity to come to market. We're seeing it already. I mentioned there's 15 of these ETFs that are already in play, but the pipeline, I will tell you, is dramatic. And so I would expect in the next 6 months, we'll see double, maybe triple the number of semi-transparent ETFs come into play. And it's the largest active managers in the world. They want an ability to tap into this growth market. They're seeing ETFs grow dramatically, and it's a better way to shield their alpha.
Yeah. Yeah, and we see some very, very successful mutual fund people moving into the active management ETF space. We're waiting for Dimensional Fund Advisors, a very successful, very well thought of organization on Wall Street, waiting for them to make that move over. They've already announced that. But give me some dollars. I mean, what could we attract $1 trillion, $2 trillion next year? Could we be sitting here at this time next year saying the ETF business is an $8 trillion business and $2 trillion of that is active management? I'm pushing you a little, but stop being so abstract. What does it really mean?
It's always hard to predict the future, right, Bob? I mean, none of us has that crystal ball, but we do believe we're planting a forest, if you will, and maybe it's not a 6 month or a 1 year time frame, but we do ultimately believe a large portion of the actively managed funds industry will move into the ETF for all the aforementioned reasons. So, yeah, I don't think it's unreasonable to say there'll be $1 trillion in actively managed ETFs in the next year or two. I think that's a reasonable goal. We're seeing it happen. We're seeing people in the works of working to convert traditional mutual funds direct into an ETF. So if conversions start to take off, you can imagine the dollar movement very quickly. And even if it's not a conversion market, you'll probably see a lot of clone strategies come to market, people who are running very successful, large, actively managed mutual funds, but want to do so in an ETF wrapper. So again, it's more about opportunity, and it's more about a growth story than anything else for active managers to be able to use ETFs.
Yeah. And guys, feel free to jump in at any time. Go right ahead, Jan.
One observation. I mean, it's stunning. You know, we had a lot of difficulty with fixed income ETFs in March and April, right, with big discounts to NAV. A lot of dysfunction in the markets overall, not just ETF related, obviously. But it's just stunning the demand that investors have for liquidity and transparency of ETFs. I mean, it's as if it didn't even happen when you see the inflows, subsequent to that. Both on the fixed equity side, of course, but on the fixed income side is more eye-opening to me. I just would have thought that we would have gotten more questions, and there were questions for about a month, and then the inflows started. So I think Doug's got a really easy job.
Well, why weren't there more questions? What kind of questions were you expecting, Jan?
No, I just think what it reflects is that, questions as to, listen, why is my investment grade fixed income ETF at a 5% discount to net asset value? Or another, others were well over 10 or 15% discounts to NAV from big fund families. And it reflected the dislocation in the underlying bond markets. But my main point here is investors love the transparency of ETFs when they know what they're getting, and the liquidity. It's just a great, easy way for them to put money to work in a very defined manner.
We haven't hit on high yield yet, Jan, and guys, feel free to jump in. I know, Jan, you run 2 high yield funds at least, the Angel, the Fallen Angel ETF, and the HYD, which is the municipal bond high yield ETF. So what's the bet now, Jan? Is the bet that a credit crisis is unlikely? We're seeing rallies here in all these high yield ones. Is the bet that a credit crisis is unlikely with a reopening story? And I guess I'm wondering, can we make it to the other side without a lot of defaults? The market's kind of looking over this valley here that we're going to have for the next 3 or 4 months. Your thoughts on high yield?
Well, I mean, everyone's been able to refinance at lower rates, which has really given the boost to fixed income and high yield. We didn't see as many defaults in high yield as we might have thought this year. So corporate, look, you can get income only one of kind of 2 ways. You really can't even lengthen duration anymore, right? You can't go to a 10-year or 30-year bond. So you have to take more credit risk, which is why people are looking at high yield, and you still get a 4% pickup in yield. And there's obviously a lot of demand for that, especially the backdrop of the world economy getting better that I talked about before. I think the muni market is much tougher. There was a lot of disruption and a lot of pain there, and it really depends on the political solution if Washington will bail out some of the states here.
Yeah, I think you
let me
wonder
jump in real
there
quick,
hasn't been
Bob.
as many. Go ahead.
Well, sorry. Well, I just, you mentioned Washington, and the biggest driver to me for the high yield market's been the Fed. And if you think about really both the implied put and Jan's fallen angel fund, I mean, if anything, it's targeting being there in the on deck circle, waiting for any of these big companies and corporates with huge exposure across multiple asset classes to fall. And I think that backstop by the Fed has been most beneficial in high yield. And frankly, that backstop's going nowhere. So the Fed is asking everybody to reach out the credit curve and the risk curve, and they're there. And I think if anything, again, 2 years ago we were talking about that mass of triple B into triple B minus that was at risk of teetering into high yield, and the devastation that might find. I mean, the irony is, of course, that the Fed's still buying Apple's debt, but they're threatening to buy all of the high yield debt as needed. And that's actually driving returns without them having to spend much money.
Right. I was going to say exactly that. It's the implied put. I mean, the Federal Reserve has essentially ring-fenced high yield. You can't do any better than that at this point. Jan, while I got you here, gold, you're one of the gold mavens out there. Can you explain why we're seeing the weakness in gold recently? Is it about interest rates? Is it about inflation? Is it about the is it about the dollar? And what about gold versus Bitcoin? Is there something to that equation about one playing off of the other?
Well, certainly we're less bullish on gold because of what potential rise in rates. We're calling for maybe on the 10-year next year to get to 1.5% to 2%. So if real rates go up, I always say that's the enemy of the gold trade. So we're a little less bullish, and we don't think that's tremendously disruptive to the gold bull market, but it is a little bit of a headwind. I do think Bitcoin has been the asset of the year, really. It's rallying right through this rotation to value that Tim was talking about. So I do think that is taking away some marginal demand for gold. But still, there are many investors that will only stick with gold. So that's
is there actually a trade like that, Jan? Is there a trade out of gold and into Bitcoin? And I mean, what would be the rationale there for that, other than to look for one relatively, high beta investment to another one, or really high beta investment?
Well, I think there's always alternatives. Gold competes with silver. Gold competes with gold shares. There's always other stores of value, and we've been trying to push for a Bitcoin ETF for years, and we think that Bitcoin is another type of competitor to gold, and you should own a little of each of those. That's really my take.
Do you think we're going to get a Bitcoin ETF under a Democrat controlling the SEC?
No idea.
Stay away from that one. Okay, we're going to move on. Nobody's raising their hands on this one.
Keep
okay, go ahead. All right. Hey, Tim. This is the part of the program where we ask about pot ETFs. Those of you who don't know, Tim is our maven on pot. He's long a number of names. He's the portfolio manager of a cannabis ETF, and he sits on advisory boards for cannabis companies. So the full disclosure on all of this. Tim, they've been all over the place, although CNBS is okay. Tell us a little bit about what's going on.
Bob, you're the one with the psychedelic posters behind you. So, but now let's talk about cannabis. The dynamics in the cannabis sector are really extraordinary. And the top down and through the election cycle, we saw 5 new states vote through either adult or medical markets. The top line growth story is 30 to 40%. I don't need to get too deep into the top-down consumption story. This is CPG. This is very sophisticated, and the country's in favor. So it's really going to be about finding the right exposure. So in ETF land, look, we're the only cannabis derivative-free cannabis ETF that's up year to date. And if I looked at my screens coming in, I think we're up about 10.5%. If I'm looking at my Reuters screens this morning, the largest cannabis ETF is down 23%. So this is all about active management. This is all about being someone that's investing in a sector and in the middle of the sector, talking to companies and watching the allocations, because it's moving very quickly. But it's notable how profitability in the sector, which was once thought of, hey, growth at any cost, and a lot of the big Canadian names, frankly, were spending money not only that they didn't have, but to build capacity to nowhere. And I think part of the trade has been, first of all, as you would do in any active portfolio on the way down, and it was a vicious bear market, it was about being defensive. It was about finding the best balance sheets. It was about finding the companies that actually hadn't levered their balance sheet or put a bunch of dilutive equity warrants in their structure. So that's really what we're doing at CNBS. And I think the sector, people may or may not believe in what's going on in the cannabis story, but again, this is a national issue, and the macro on it, which continues to be one where states are plugging holes in budgets and fiscal through cannabis legalization, and the country doesn't care. More importantly, it's a very sophisticated consumer product story, and active management and being thematic in this space is what we do, and it's working.
I love that line. It's a very sophisticated story. I don't hear that a lot about pot ETFs, but I appreciate that. This is for intelligent people, Bob. This is not for you, Bob. Well, I'll explain it to other people later on. But thank you for clearing that up for us. I love the Led Zeppelin poster, by the way. Don't think I didn't notice that, all right? I got my eyes open here.
Doing what I can, Bob. Doing what I can.
Fellow old, you're just an old hippie like me. There you go there. Thank you, gentlemen. I very much appreciate it.
Thanks, Bob.
You coming around. Jan and Tim and Doug Jonas, all friends of mine. The best in the business, guys. We get them here every week with us. And that does it for this week's ETF Edge. And my thanks, of course, to my friends. Join us on Thursday for a special edition of ETF Edge. I'm very excited about this. We're going to do a whole special program on multi-factor ETFs. Can you outperform by combining investment styles like momentum or value or small cap all together? Can you do that? We'll find out. 3 of the best with us, 1 p.m. Wednesday, 1 p.m. Thursday, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.